Good afternoon, and thank you for joining us for the third webinar of our Business Recovery Series. The series is intended to provide businesses with training, information, and resources necessary for business success, recovery, and preparation for unplanned events, and is brought to you by the City and County of San Francisco Contractor Development Program and the Alameda County Contractor Technical Assistance Program. Both programs are administered by Merriwether Williams Insurance Services. And today's webinar in this series focuses on proper development and utilization of profit model based upon a business model. The profit model addresses all the core elements of the business operating system that go into making a company viable and profitable. Now, before we begin, I would like to go over a few housekeeping items. If you are experiencing any technical or audio issues, please reach out to me via chat box, which is located at the bottom of your screen. If you have any questions anytime throughout the presentation, please type in your question in the Q&A feature, which is also located at the bottom of your screen. An email evaluation form has been sent out this afternoon, I believe an hour ago, to gain your input and feedback. So we hope that you complete that. It'll be very helpful for us. I also like to mention that a PDF copy of today's PowerPoint presentation and link to a video on this topic will be provided shortly after the webinar. Please also note that this webinar is being recorded. Now, with that said, my name is Judy Singharath, Marketing Manager for the Alameda County Contractor Technical Assistance Program, or CTAP. CTAP is designed to help small contractors to obtain bid, performance, and payment bonds and or help increase their bonding capacity on work for Alameda County-led projects. Some of the services that we do provide are one-on-one consultation to determine what your bonding status is. We assist contractors in obtaining bid, performance, and payment bonds by providing collateral of up to 40% of the bond amount or $750,000, whichever is less. We also offer technical assistance, referrals to brokers, bookkeepers, and accountants. To be eligible for our program, you must be domiciled here in Alameda County or able to participate in one of the following certification, which includes the Alameda County Small Local Emerging Business, also known as the SLEB certification, the SBE, DBE, LBE, MBE, and WBE. So for more information about CTAP, I encourage you to reach out to our program manager, Carol Henry, whose contact information will be provided at the end of today's presentation. Now, without further delay, I want to pass the mic on to Jennifer Elmore, who is our program manager for the City and County of San Francisco Contractor Development Program. Welcome, Jennifer.
Thank you. My name is Jennifer Elmore, as Judy said, Program Manager for the City and County of San Francisco Contractor Development Program, or CDP for short. CDP is a team of people that are here to assist local business enterprise businesses to navigate either starting work or working on San Francisco projects. CDP works with the LBEs to ascertain your business needs and to ensure that you have sufficient resources to enter into contracts with San Francisco. The goal is to assist LBEs in their growth and to remediate some of the barriers that might prevent you from being successful. The first step that we do is we set up an appointment for a one-on-one evaluation to identify which technical assistance services your business may require. The goal of the evaluation is to create a strategic development plan that fits your business's needs and that utilizes the services CDP offers. Some of those services include marketing, estimating, safety, and accounting financial services, and that's just to name a few. Our objective is to assist in the growth of your business and assist that LBEs have sufficient bonding through the surety bond program and or financing through our newly developed Contractor Accelerated Payment Program, or CAP, when working on San Francisco qualifying projects. Please contact us via email to set up an appointment to discuss how we can work together. You can contact us by replying to the email that was sent about an hour earlier today with the evaluation. As a reminder, please complete the webinar evaluation, as your feedback is important and helps us improve and provide seminars that are most helpful to your business. I want to thank you for attending, and please allow me to introduce our presenter, John Miller, CAP Program Manager. Thank you.
Thanks so much, Jennifer. It's a pleasure to be here today, and it's a pleasure to be presenting the third in our recovery series, as Judy mentioned, on profit model to business model and to proper markup and gross profit margins calculations for said. Our first program that we did last fall focused on financial accounting basics, how to set your books up. Recognizing that certain financial reports like balance sheet, profit and loss statement, work in process reporting, and cash flow projections were essential to the nuts and bolts on a day-to-day basis of running a construction company. We then transitioned into the second program, which was on cash management, where we attempted to connect job cost reporting on the project level to management level financial reporting in order to better manage your cash with cash flow projecting and so on and so forth. This third presentation today, I'd like to mention the fact that our colleagues from Strategic CFOs, Ed Gines and Mina Choi, are actually joining the presentation, and Ed will be running the PowerPoint for us. This third presentation is a bit ambitious, but we think it's fitting here at the beginning of the year to kick it off with an overview of what constitutes some, we think, very important strategic business model planning. So without further ado, if we could transition to the slide program, we'll take it from there. Okay, so today, profit model to business model and markup versus margin. Now, at Merriwether Williams and within the contractor development program, we are well aware of the fact that as a lean startup or a contractor that may only have a couple of years in the business, you're typically going to be duking it out in the field every day, getting home at night, perhaps getting caught up on the books, getting billings out, working on perhaps an estimate on a new project or a schedule, and there's really little time potentially for doing a deep strategic business model and sales planning. What we'd like to do though today in presenting this information is to give you the highlights, to define the business model that we see contractors operating on a day-to-day basis, the profit model associated with that business model, and then concentrate a bit on the importance of properly marking your work up in order to achieve the desired financial results that you'd like for your company. So if we could go to the next slide, please, Ed. Okay, so what we're going to do is identify your profit model today. We're going to show you how to develop a strategy that leads to an effective business model, get the highlights of that, help you define what a business model and understand that it creates opportunity for revenue and profit. And with that opportunity to generate revenue and profit, how you price your work is essential to your company's growth and its long-term survival. So without further ado, let's go to the next slide, please. So what do we mean when we talk about profit model? And what I'd like to do is to make the indistinguishable connection between profit model and business model as we go along today, because understanding your profit model is inextricably tied to how you execute your business plan and the constraints associated with properly pricing the work that you land as a contractor. But talking about profit model and kind of giving you a context of what that is, we're surrounded by profit models. A few examples would be, for example, Facebook, which is a profit model where the product essentially is free, but revenue comes to the Facebook through advertising income. Another example of a profit model would be price based upon low recurring subscriptions, sort of like the Dollar Shave Club or Harry's Razors or some of the subscription-based vitamin programs that are out there that you hear advertised on the radio all the time. Another profit model that as a contractor you may be more familiar with would be the low price product where support and add-ons are extra, and that would be the Primavera estimating system as an example. We could go on and on about profit models, but I'd like to also mention that just using Amazon as an example, as your company grows and prospers, hopefully, there is opportunity to embed more than one profit model in the structure of your company, sort of like the way that Amazon is set up today, where Amazon started off as an e-commerce company, but now runs a number of profit models associated with the various programs that they offer. So as a contractor, your profit model is product costs plus margin. Sounds pretty simple, but it is without a doubt one of the most difficult profit models to execute on if you don't have it connected to a well thought out, well communicated, and well documented business plan. Now, should I pause and take any questions here? Are there any questions from the floor before we proceed? Okay, we could go to the next slide, please, Ed. Okay, so now we're going to talk about the high points of a business model, understanding what our profit model is and how it connects up to a business model. Now, again, we're very, very aware that as a small business, as a startup, there's little or no time in your busy day to focus on a bunch of highfalutin business or B-school theories here, but we've got basically 7 areas that an effective business model would cover. And I'd like to share those 7 areas with you as the fundamentals to developing your business model. First of all, you want to identify your target market. We're going to provide you with a matrix approach to documenting all of this as we get further into the program. But identifying your target market is just as simple as understanding that you may be actually selling into the project owner marketplace. You may be looking at prime contractors as your primary customer. You may be operating as a second-tier subcontractor where first-tier subs are your customers. So identifying your target market is the first step in developing an effective business model. The second step would be to recognize the key activities you perform. Now, if you happen to be a specialty trade contractor, you certainly, an electrician as an example, or a drywall contractor, or a roofing contractor, you certainly understand the key activities associated with the work that you perform. But beyond those key activities, there are means and methods associated with those activities, the estimating process that may be discrete to those activities, scheduling, cash flow projecting. All of these things are key activities associated with the trade or the specific work that you perform in the conduct of your business. And these activities need to be recognized in your business model, if nothing else, as a component of opportunity for generating revenue, as well as the attendant costs that go along with generating those revenues. So if we could go to the next slide, points 3 and 4. The next thing you would want to look at, again, in taking a high look at how to structure a business model, would be the key resources that are needed. Most of you are familiar with the licenses that are required in order to get your company organized and off the ground. There are regulatory requirements that need to be recognized and dealt with as part of your business model. And certainly the old capital, equipment, labor, training, and safety. All of these key resources need to be recognized and documented, and where you stand in relationship to those resources will be translated into what it is you need to do in order to execute on your business model. Next, you want to develop your value proposition. And that's sort of a far-fetched term for basically defining what it is you are offering your customers that will attract them to your business and embed them as long-term relationships. But this process really starts as early as pre-qualification with various prime contractors or project owners. What you have as an opportunity there in developing your value proposition, even at the pre-qual stage, is defining differentiators between you and the potential competition. And I'll give you some hints as to how those differentiators can be defined when we actually look at the business model format that we have in store for you today. So again, key resources and developing your value proposition and being able to adequately incorporate that into your business model are points 3 and 4. Now I'd like to pause. Are there any questions so far as I'm going through these points that anybody would like to raise?
Looks like there are no questions coming through, John.
Okay, very good. Okay, let's go to the next slide, please. We'll get through this high-level sort of overview of what we're talking about. Okay, so key partners, number 5, to developing a business model. This is near and dear to us because within the Contractors Development Program, this is for many contractors their first opportunity to drill down on potential relationships with a certified public accountant or an accountant or a bookkeeper. These key partners that I'm listing here are very, very important to the development of any business. And I'd like to tell you that within the Contractor Development Program, we can help you with connections in each one of these areas, whether it be a CPA, recommending at least the criteria that you would be selecting your insurance and surety consultancy on. Through our CAP program, we can talk to you about how to prepare yourself for the lending process in the commercial market, as well as our CAP program. We've got third-party consultants on staff in the area of helping you to develop your business plan, your business model, also in the area of estimating and scheduling. We even have third-party funds administration as part of our overall program, and the individuals that man that company are also very, very good as third-party consultants to the contractors we work with. You may find also in identifying your key partners going forward that certain suppliers can become very important partners to your business, especially if the type of material that you incorporate into your projects is of a very specialized nature with specialized applications, means, and methods. So very often contractors will recognize as key partners their key sources of supply. And of course, service providers in the form of third-party payroll service providers, we see as very often an indispensable part of the key partnerships that local business enterprises will need to rely on. Point number 6 is recognize in your business model the opportunity to create demand. I mentioned a little bit earlier pre-qualification and the opportunity that presents in order to get a handle on what kind of a value proposition or offering you need to make to your potential customers. But in creating demand, what you're basically trying to do is build interest in your company. And one of the points that I like to make is that by even pre-qualifying, you're saying to a project owner or a prime contractor, hey, I'm out there, I'm new competition. You would like to have more competition in bidding your work, and we can fill that bill. You also look for opportunities to create demand through one-on-one touch, and that is an absolutely indispensable component of your business model and your plan. And if we could go to the next slide, number 7, and the final point that I want to make about the components that go into a successful business model would be the commitment to innovate. And I like this one in particular because it's a well-known fact that over 70% of all innovation in the construction field occurs at the field level. It occurs very often at the specialty trade level. And as a contractor, your recognition of opportunities to innovate, to improve on your target customer's ability to realize the goals and objectives of a project within its scope is an absolutely essential part of your plan. So the idea that you adopt early on accurate initial assumptions about the project and your project owner or prime contractor's goals for the project, and then commit to find opportunity to innovate throughout, will further cement your business model and your relationship with that customer. So again, kind of ambitious here to share these 7 points with you. We'd like to think that in considering developing a business model and working with our team or working independently, you'll be able to come back to this presentation and say, oh, these are the components that go into an effective business model and profit model. So if we could go to the next slide, or are there any questions on these high points that I've mentioned? Should I stop and take questions there? Okay, without further ado, let's go to the next slide then. What we're going to do now is transition, I should say, from these high points of what constitutes an effective business model to how you get it down on paper. The intended outcome here obviously is a customer-focused approach to your business that is flexible, it's on one page, it's easily referenced, it's easily communicated to your team, and it's fully transparent. It gives you an opportunity to continuously track how you're executing your business. It should provide you opportunities, new opportunities as you're working with target customers to develop additional business with them, and again, the opportunity to apply and deliver customer-driven innovation. This is not a new concept. Actually, it's new relatively, I guess, in the business world, in as much as it's been around since the early 2000s. This is a format that we're using in our practice right now called the Business Model Canvas, that was actually developed for lean startups throughout industry. The construction industry, we think, is particularly adaptable to this format in the lean startup stages of their business, but it could apply to in any type of business, whether it be retail or high tech or whatever. But in any case, let's move on to what the Business Model Canvas looks like. Next slide. Okay, there we are. Now, the process that we're recommending to you is to essentially just whiteboard the idea of putting together a business model, okay? And if you were to just put this up on a whiteboard, a matrix like this, what we've done is we've divided this canvas into 3 quadrants. One would be the structure of your company. The next would be what you're offering in the way of a value proposition to your target market. And then an inventory of your customers' needs and touch points that would inure you to, or closer get you inculcated in their operations and a valued service provider. Okay, so by putting this type of a matrix up on the board, which basically breaks down the infrastructure of your company, defining key partnerships, as we mentioned earlier, key activities and resources, your offering in the form of a value proposition, and then defining your customer relationships and the segments in the marketplace that your customers occupy, and what your service channel touch points would be, we think is a great start to defining your business model on a simple one-page document, which also connects up to revenue stream impact and the opportunity to generate sales, while recognizing the fact that the cost of goods sold that come about as a result of generating revenue have to be properly managed in order to generate a profit. And all of this determines your company's growth and survival. So the next slide will provide some ideas of how this business model canvas is populated. Imagine, if you will, this is up on the whiteboard. and you're examining each one of these quadrants of the canvas, the infrastructure or structure of your company, your offering in the form of a value proposition, and your customer, your potential customer base. I mentioned earlier that your key partners might be defined as your CPA, your surety, your insurance company, your lender, possibly your attorney. I had thrown in there the potential that key partners could also include suppliers and consultants in the area of estimating and scheduling, certainly in the area of shop drawing and submittal preparation, so on and so forth. So key partners is very, very important, and to make sure that you've got key partners that you can look to as trusted advisors is a very, very important part of any business model. You would define within the structure of your company key activities, such as where you stand in terms of your financial reporting. Do you have report generating capability that will help you manage your business model effectively? Have you got key estimating and project selection protocols in place? And do you have the training and supervision in place? Those key activities in conjunction with the type of work that you perform are absolutely essential to the structure of your company. And of course, an inventory and absolute making sure that you have the key resources in place. So you've got the labor you need, those indispensable assets of equipment, either owned, leased, or rented, and access to supplies and materials and relationships there. So these are just some ideas on how the business model canvas, this one page, very simple, very translated, transparent and easily communicated canvas, can be populated in the area of business structure. In the area of your value proposition, we throw a few ideas up here. The idea of a value proposition based upon customer specific, on time, on budget delivery, perhaps with elements of total quality management incorporated in it. Of course, the innovation that I focused on a little bit earlier. And of course, as a local business enterprise, you're uniquely positioned to help your target customers fulfill their set-aside goals, which is a major component of your value proposition going forward. Some ideas in terms of populating the customer relationships would be the very basis upon which you're contracting with customers. Understanding the ins and outs of a lump sum contract, cost plus, or purchase order type arrangements with your customers. What are the expectations associated with you fulfilling your obligations and them fulfilling their obligations under these type of contractual relationships? Looking at your service channels or touch points. I mentioned earlier that your very first opportunity many times is in the pre-qualification process to develop a touch point with a potential customer, but that typically would then advance to pre-bid, project review, a term we use called the Show Me, a pre-bid conference where you're actually able to look at what the scope and the objectives and the goals for a project are, and to make a determination on whether or not that project is a good fit for your company and what you might bring to a potential owner through an analysis of the project in the pre-bid stages. Then you've got your point of award and scope. And here, obviously, you want to make absolutely certain that the specification that you bid translates seamlessly into whatever your design submittals are, so there is no miscommunication as to what it is you are intending to provide your customer, and that those expectations on the part of your customer are fully met. In terms of customer segments, I've mentioned the fact that you're probably bidding to project owners, prime contractors, subcontractors in a first-tier position. Analyzing those segments and what their needs are and what their journey is as a contractor is very, very important to your business model. So again, these are just some ideas of how to populate the business model canvas. And of course, each one of these areas, structure, offering, and A knowledge of your customer and their needs translates into revenue sales streams based upon developed customer relationships and profitability based upon having properly applied markup to achieve the type of margin outcome or profit outcome you're intending for your company. So now I'd like to kind of summarize what we've gone through. If we can go to the next slide, please, Ed.
Hey, John, I actually 2 questions that came through, if that's okay, and answer
Very
that.
good. Yes, thank you.
The first question is, how do I learn my customers' goals and journey?
Well, you know, I think it really starts in developing a relationship in the pre-qualification stage of working with a target customer. You know, the type of work that just to throw some names out there, the type of work that a Swinnerton does, the type of work that a Webcor does or a Pankow does, each one of these companies might have their own signature or goals for quality and on time, on budget delivery that you need to try to identify and make sure that your business model corresponds well to what they're trying to accomplish in the marketplace, what their to use a term, what their journey is. Hopefully that makes sense to you. And certainly if I haven't answered that question adequately, we'd be very happy to follow up after the seminar, but hopefully that answers the question. Knowing your individual general contractor or subcontractor or project owner's goals and reputation in the business are very, very important to tailoring your business model to their needs.
Thank you, John. And then the next question is, do you have any suggestions for finding more channels or customer touch points?
Well, as I say, you know, it starts with pre-qual, but I think that there are probably industry functions that you can attend where you're going to get a grouping of representatives from various companies. You might want to keep your eyes peeled for those types of opportunities. I think relationships are very often best built early on where maybe even a specific opportunity isn't under discussion, where you're basically seeking an alignment between your company's goals and objectives and what you can discern their goals and objectives are. But again, pre-qual through plan review, pre-bid, going to the show-me's, and then you have opportunity even at point of award and scope to build on relationships, again, as you're looking at the scope and the goals and objectives of your project owner or prime contractor.
Thank you.
Okay, so a quick review, if we could, to just kind of hit the high points. And again, this was a very ambitious presentation today in that I know we're throwing a lot at you with respect to sort of highfalutin business school concepts with respect to a business model, but hopefully again, you'll be able to refer back to this at the point in time that you do attempt to do some strategic planning. And certainly feel free to rely on our contractor development program and my colleagues and myself that are involved there to help you with development of the basic elements of a business model. So today we said we would discuss your profit model, which is product costs plus margin. Sounds simple, but is pretty risky, and you need to execute very, very carefully on that model in order to achieve your financial goals. The last part of our presentation today will focus on this product cost plus margin concept. We said we develop a strategy or define a strategy that addresses all the core elements of your company and leads to an effective business model. That would be the business model canvas that we reviewed, and its flexibility and adaptability to whatever your intended outcomes are with respect to a business plan. Effective business models, if I haven't driven this point home, really create opportunity for revenue and profit. And that leads us now to the final portion of our program today, which is how you price your work to profit is essential to profitability and your company's survival. If we can go to the next slide, please. Okay, so what we'd like to discuss at this point is markup versus margin. And this is a conversation that I've been having with contractors, well, for all of the 40 years that I've been in the business. You know, your business model, as we reviewed before, is going to generate opportunities for revenue, and there are going to be costs associated with delivering and generating that revenue. So what we like to do in addressing markup versus margin is start with just a very basic review of what constitutes a project cost breakdown. You've got basically 4 elements that break down direct costs on a construction project. It would be your payroll, your materials, your equipment, and your subcontracts. And when we talk about payroll, in particular, we're talking about fully burdened payroll. And this is an area that we spend a lot of time on in our CDP program and making absolutely certain that the local business enterprises that we work with are availed of tools to use in order to properly burden their payroll, to understand what burden is. Many of you probably already do, but again, it's a very, very important component to getting your work properly priced. From your basic project direct costs, you want to mark those costs up in order to determine a margin or gross profit, which of course covers your general administrative expenses and generates a net profit for your company. So it's essential that in breaking down the project, you get the payroll, the materials, the equipment component right, and then properly mark it up to achieve the intended gross profit margin. Okay, if we can go to the next slide, I'm going to spend a little bit more time talking about fully burdened labor and its components. Here's an example of how we look at a payroll. The taxable wage, which is your base wage based upon craft for apprentice or journeyman or foreman, to include any vacation or holiday pay expected in the schedule of the project that you're anticipating, in order to come up with a subtotal for taxable wages, your basic wage rate on the project. You would then incorporate taxes and insurance on an allocated basis to that hourly wage rate. Your Social Security, your Medicare, your federal taxes, your state taxes regarding disability and worker injury on the project. Those types of taxes need to be allocated, and your third-party payroll provider, if you use one, is essential in helping you determine what those factors should be as applied to your base wage rate. You would also allocate insurance costs for worker compensation insurance and general liability insurance, usually expressed in an amount per 100 of payroll value. You would superimpose that on the basic hourly rate. You would also include in your fully burdened labor rate your cost of fringe benefits, your labor dependent costs in terms of transportation costs for employees or paid leave act, this sort of thing, in order to come up with a total straight time hourly rate. Now, there may be other factors of burden that need to be incorporated that are specific to the work you do, but this is just sort of a basic outline. And through the Contractor Development Program, as I mentioned, we do have a tool to be used. It's a matrix tool to help you calculate fully burdened labor for all categories of work, whether it be apprentice, journeyman, or foreman. Okay, so having focused on what we mean by payroll, fully burdened, let's go to the next slide, Ed, please. And what we're going to do is address what we call the mistake of markup versus margin. Now, in terms of job costs, on the previous slide, we documented that your direct job costs typically consist of your payroll costs, your material, your equipment, subcontract costs of any. We refer to that as cost of goods sold, direct cost of goods sold. Okay, so if you are looking at a construction project and you've totaled up your costs for all those areas, and they, let's say, come to $80,000, you've got to, in order to generate a gross profit margin, expected gross profit margin, let's say 20%, you've got to mark those job costs up by 25%, a multiple of 25%. This is a twist of math that has tripped up contractors and surety bond underwriters, I might add, and lenders forever. But if you were to just take those job costs and arbitrarily put 20% on top of them, you would not achieve the profit margin that we're looking at in this very simple equation. So if your job costs are $80,000 and you mark them up by 25%, or $20,000, 25% of the $80,000, you would have a total contract price on that project of $100,000. And through this twist of math, if we take the markup, which on this project is $20,000, and we divide it by contract price, you come out with a gross profit margin of 20%. Okay? Imagine using the same model if all you did was apply 20% to that 80,000. That would increase your job costs by approximately $16,000 for a total contract price of $96,000. And if you took your $16,000 in terms of your what would be your intended profit on the project, and you divide it by 96, 16,000 divided by 96 gives you a gross profit margin of only 16%. So if your gross profit margin goal is to earn 20%, you got to mark it up by 25. You can't just add 20% to the 80,000. And this applies to projects where if your goal is to earn 25%, doing the math very simply, you pretty much have to mark it up by somewhere approaching 30% in order to generate a 25% gross profit margin. So going from this illustration, this equation here, to what might be a little more familiar to you as you're operating your business in the form of a sort of a profit and loss look at this markup versus margin. What we've done here is we've taken the same factors that we used in our previous illustration of total cost of goods sold, $80,000, okay? And we've marked those cost of goods sold up by 25% to come up with a total income or contract price of $100,000. And in looking at a very simple P&L, profit and loss statement type of an illustration here, if you take $80,000 from $100,000, you generate a gross profit of $20,000 or 20%, all by having marked up those costs by 25%. And using the old 20, 10, and 10 rule, you've got, at least based upon this model right here, $10,000 available to cover your general administrative expenses, and $10,000 going to the bottom line for net income. So, do I have any questions about markup versus margin and the importance of differentiating markup from gross profit margin? In other words, getting the proper markup on your hard dollar costs in order to achieve a margin. Any questions here at this point?
Looks like there's no questions.
Okay. All right. So the true importance of this, I am repeating myself, but the true importance of this is that as you execute on your profit model and your business model, okay, you're going to generate revenue, you're going to generate attendant costs, and how you price those costs, how you mark those costs up is of extreme importance to the successful outcome, and you're meeting your objectives for generating net income for your company. Okay, if we can go to the next slide, we'll kind of sum things up here today. Okay, as a final review, hopefully we've drilled home the point that recognizing your profit model, product costs plus margins, okay, is essential. And developing a strategy that addresses all the core elements of your company, that business model canvas, leads to an effective business model to create revenue and profit. And understanding that markup versus margin are two very different things, but properly marking your work up is essential to profitability and your company's survival. So that concludes our presentation. I'm happy to take questions at this point if there are any questions from the floor.
There is a question. Why do we mark up the 25% to earn a 20% margin? Is that the margin profit?
Yeah, let's go back to the illustration. And by the way, I'm not advocating that 25% is the right number. Let's go back to the the equation, if you would, Ed, please. You know, in getting your arms around this concept, there's a twist of math here. As I mentioned, I kind of ran over quickly. If we were to just slap what we would have as a goal for gross profit margin on that $80,000 of costs, let's say our goal was gross profit of $20,000, 20% on 80,000. 20% of 80,000 translates to $16,000. Okay, and when we take that $16,000 and we add it to our cost of goods sold, that only comes up to a contract price of $96,000. And when we divide that $16,000 that constitutes what we think is going to be our 20% profit by the contract price, we only come up with about 16% gross profit margin. So it's essential that when you tally up all of your costs, that in order to decide, and when you decide on what type of a gross profit you think you need in order to cover your general administrative expenses that are unallocated directly to the job, and a reasonable net profit on the project, you need to mark the costs up accordingly. And in this illustration, we basically said that this contractor for this project had a gross profit margin of 20%. By marking up his hard dollar costs by 25%, that gross profit margin is achieved, and you're able to cover then your unallocated general and administrative expenses and your net profit, which is illustrated in the next slide. If you'd like to take one more look at that. Our total cost of goods sold at $80,000 is marked up by 25%, which would be $20,000 for a total contract price of $100,000. Less the $80,000 gives you gross profit of $20,000 or 20% as it relates to the overall contract price. And you have then a budget to cover your unallocated salary and general administrative expense that you carry in the day-to-day operations of your company that hasn't been allocated as a direct cost to the project, and some net income left over. And by the way, if I failed to point this out, if you look at this illustration right here, we've incorporated as your direct costs that payroll and material and equipment and subcontractor costs that I mentioned in the earlier illustration. So this is just a vertical profit and loss style illustration of how markup versus margin works. Hopefully that has answered your question. And if there's a follow-on to that, I'm going to go over my contacts, or our contacts, I should say, as a team, so that you can ask any follow-up questions. Are there any additional questions that I can address at this point?
There is one more. The question is it fair to mark up jobs for city agencies? What's the ethical percentage for that?
Well, it certainly is. You are certainly allowed to mark up projects for any city agency. But there are some guidelines. You're going to find embedded in contracts guidelines for marking up change orders versus the basic work that you're doing. But I'd like to invite Jennifer Elmore of our CDP team, who has a good knowledge of markup allowances on city-run projects. If you can jump in and comment on that question.
Not a problem. So one of the issues with the markup is, and if I believe it's 15% is allowed markups on change orders within the city and county of San Francisco. One of the issues that people omit or discount is there are a lot of costs that you can include in that before the markup, and you mark up on that. And most contracts spell out what are permissible, allowable items that you can include in that markup. And it's usually 15% for the city for change orders. And it'll depend on your contract. And because, you know, we're talking generalities, other city entities may do it differently. So read through the change order section in your contract. That should list all the items that you can mark it up, as well as the ultimate markup and the line items that you can do.
Yeah, and again, our goal here, thank you, Jen, thank you very much. Our goal here today was to make you aware of that twist of math. The idea that you can't just put what you would expect to be your needed gross profit margin on top of your costs and say, well, that will be my gross profit at the end of the job. What you need to do is to come up with a factor, an amount in terms of markup that will then yield your intended gross profit. And I would hope, notwithstanding commercial market pressures, downward pressures always from project owners and primes on the amount of profit that you're going to generate on a project, but the ability to at least get a 20% gross profit, to me, seems to be an industry norm, and hopefully that's achievable in bidding city contracts.
John, there's one more additional question we want to make sure we answer.
Sure.
If there's more, we're willing to answer those. The administrative costs, like making payroll, doing the certified payroll, this cost does not come from the profit, right? So if you don't mind, I'll answer that question and you
Sure.
give more. So one of the things when you're doing your markup and you're doing profit is that you have general and administrative expenses, and the payroll, as well as those types of things, should come out of that portion of your overhead, and profit should be pure profit. So do you mind adding something to that, John?
Well, I was just going to say that if you break down the cost structure of a project, you have direct expenses, as we reviewed today, your payroll allocated to the project, your materials directly allocated to the project, you have your equipment allocated, and of course the cost of subcontractors. You're going to have other unallocated general and administrative expenses associated with putting together your payroll, running your office, paying your office rent, cost of insurance that isn't related to specifically to a job. That's where your growth, when you calculate what you need in the way of gross profit, you've got to be able to generate enough gross profit on those direct costs that you have in the project to then trickle down and cover your embedded fixed and variable general and administrative expenses. And then at the end of the day, have some profit left over to contribute to retained earnings so you can move to the next project. Hopefully I've summarized that in a way that everybody can understand.
There's another question. Cool, that is how I understood it. But sometimes I don't charge enough to cover the administrative costs. Thank you. It was less of a question, more of a comment. I apologize.
Very good. Very good. Well, glad we could help out in that area. It's a key element to all of this. If you're going to deliver on your profit model, okay, you've got to be able to price that work that you generate through your business model effectively and accurately in order to have a successful operation. No question about it. Any other questions from the group? Okay, with that, we are ready, willing, and able to work with you. Here are our contacts for us. This program was recorded, and if there are any other housekeeping items, I'll defer to Jennifer or Judy here, but that concludes my comments for today. It's a great pleasure. I can't wait till we do another one of these here at some point in the first quarter of 2021, and stand by for that announcement, and look forward to seeing all of you again. Thank you.
Thank you, John. Thank you, Ed.